Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and we saw a pretty dramatic week last week with regards to a V-shaped sell-off that was, or rather a V-shaped recovery after a pretty significant sell-off that tested some major levels here, both the 100-day both the 100-day moving average on the S&P as well as a somewhat significant 680 on SPY to the downside, and the bulls managed to hold on to those levels last week. This was triggered largely off of some of the news in the AI space, with specifically Anthropic's Cowork and Claude Opus models that triggered a sell-off that wiped nearly $1 trillion of market cap off of predominantly software-based companies as big tech continues to spend what seems like ungodly amounts of money on AI infrastructure. We saw Alphabet commit to spending somewhere between 175 to 185 billion dollars in 2026. Amazon came out with that monster $200 billion number in 2026 that spooked investors a little bit on that earnings call and saw that sell off as a result. On top of that, we also saw the labor market continue to show signs of deterioration. We saw the ADP numbers come in much softer than expected. We also saw jobless claims and layoffs come up at the highest levels we've seen since 2009. Uh, this has all led to, what was initially a spike in VIX above 21% on Thursday to end up the week, below 18%, around that 17% mark. And so far, yesterday's price action continued the recovery that we saw here on Friday. And the big test is going to be over the next couple of days as the market retests the major $700 level on SPY or $7,000 level on SPX. Can we get up there? And if we do, how is the market going to react? You have consumer sentiment that came out better than expected last year. At the same time, inflation expectations was the lowest reading we've seen since January 2025. So, we're from an economic data perspective, we are moving towards what feels like a rate cut territory again. I would say over the last month and a half, there was some signs or some concerns that the rate cut expectations for 2026 was a little bit too aggressive, especially after the last Fed meeting where Chairman Powell upgraded the economic growth rate to what he considered as strong growth, and he reflected on what he called stabilization in the labor market. And that led to some investors being concerned that we could potentially be at an inflection point with the labor market. That if we start to see a little bit more strength from the labor market while inflation remains sticky, we put ourselves in a position where rate cuts are largely off the table in that scenario, and potentially even, if the labor market picks back up, that we could potentially even be headed for rate hikes, especially with the new Fed, the potential new Fed president, which who has a more hawkish nature to his views of the market. So, that's what the market's been navigating here over the last month or last few weeks or so. And what has shifted here is that we saw the 10-year yield back below 4.2% yesterday, or rather opening the markets today. And that reflects what I believe is the current view in the market's macroeconomic view, which is with the job numbers coming out on Wednesday. And the job numbers were meant to come out last Friday, but because of the mini government shutdown, that got delayed a few days. So that's coming out tomorrow morning now. The inflation print that was meant to come out earlier this week is going to be on Friday this week. So these are two of the biggest numbers that I think investors should be paying attention to this week. We saw the private payroll numbers come in much softer than expected. That's a preview of what we could potentially see here with the official non-farm payrolls on tomorrow morning. And if we end up in this scenario where the labor market continues to deteriorate, which is what we've seen over the last, call it 6 months of 2025, and inflation continues to at least not surprise to the upside, then we're in an environment where rate cuts are potentially back on the table for 2026, maybe into towards the second half, depending on how fast the labor market is deteriorating. So, that's reflected in the 10-year yield back below 4.2%. We saw that move higher above 4.2%. That was the shift in the market's expectation for economic numbers going into 2026. And I think that trend has now shifted back to what we were seeing towards the end of 2025, which was a labor market that continued to surprise to the downside, specifically consumers continuing to be more selective in their spending, while inflation continuing to move or rather inflation not surprising to the upside. So, if that's the scenario that we end up in, that's really where the call it the bad news in the labor market is quote unquote good news because that's going to likely lead to rate cuts. That's what the market has been pricing in for for the second half of 2025, and the shift towards the beginning of 2026 is kind of what's led us to be in this sort of range bound market we found ourselves in since the beginning of the year. However, with that, we continue to see this fairly sizable rotation out of tech into the rest of the market. If you look at RSP, the equal weight S&P 500 index, you see that on Friday's close, while the market was recovering, or even on Thursday's sell-off here, RSP was essentially at all-time highs, and on Friday's recovery pushed the equal weight S&P 500 index to all-time highs. And basically, since December of last year, RSP has outweighed the equal weight S&P 500 index has outweighed the S&P by a pretty significant margin. We're seeing about 63% of S&P 500 stocks are outperforming the index itself. That's the second highest reading we've seen in 50 years. And this is a relatively healthy mechanism of the market. We've seen rotation over the last 2, 3 years as tech has been the main driver of the equity markets. We've seen pockets of rotation into value, into small caps, into the rest of the market, but nothing that has been as durable as what we've seen over the last few months. So the fact that we've seen this rotation out of tech into the rest of the sectors is a fairly constructive a fairly constructive signal from the equity markets that we potentially have the legs to continue moving higher. If you see it across small caps, you see it if you look at IWM. the same outperformance. You look at the equal weight index, you look at mid cap, you look at value. All of these factors are outperforming the market cap index, such as the Nasdaq or the S&P. And the reason for that is really because the Nasdaq and S&P have such heavy weightings to the top major tech names, and those are the names that are not performing at the moment, and they have not performed in multiple months now. So this rotation is really what we're focused on and what we feel, what has legs at the moment. So that's kind of how we're viewing everything from a big picture macro perspective. And just one thing is that, TLT, if you look at TLT, the bond market. The TLT continues to generate this kind of this bearish trend that's been established basically since the beginning of November. But this is starting to potentially show some signs of life here. So we'll monitor this particular trend line this week to see if we do get that breakout here to the upside. If we do, that's going to translate to lower yields, and that could be potentially the catalyst that gives the equities the push to break out above 7,000 on the S&P and continue moving higher. But while the tech stocks kind of lag behind a little bit, the rest of the market continues to march on. And I think that's really where it's important to understand what's moving at the moment. So a few things to take a look at. If you look at EFA, which is it stands for, this is the EFEA ETF. It's an international ETF. It stands for Europe, Asia, and Far East. The international stocks is really what's taking off here. For probably for most of you viewing this session here today, you likely have the vast majority, if not all of your equity portfolio allocated to US securities. And for the better part of couple of decades, that has been what's performing relative to the rest of the world. But in the last few months, that has changed. At least if you measure the US equity markets by the S&P and the Nasdaq, and your portfolio is weighted in similar fashion to the S&P and the Nasdaq, your portfolio has not done particularly well in the last few months, while the international stocks have just continued to take off. And this really reflects the long-term valuation that the US equity markets are trading at, north of, 21 times forward earnings, close to 22 times forward earnings. There's limited upside in the long run at those valuations, and investors are simply looking for value outside of the US, and they're finding it in Europe, they're finding it in Asia, they're finding it in international stocks, they're finding it in mid cap, they're finding it in value. They're finding it in all of these places in international markets. If you look at IVE, which is the value ETF, the S&P 500 value ETF, similar to RSP, since December, this has continued to outperform the S&P 500 index. And then within the sectors, if you look at the sectors, one sector that I think are, both industrials and materials have both been outperforming. And I think that's really worth paying attention to here right now. Look at industrials broke out back here in beginning of 2026 and has just really taken off here since that beginning of 2026. So we're seeing energy, materials, industrials, consumer staples, real estate, utilities, healthcare, financials, all outperforming the S&P 500. So the wide swath of the market is outperforming. It's just technology, communications, consumer discretionary that's underperforming the S&P 500 right now. So as you look for opportunities, as you look for trades in this market, you got to look in these other pockets to find those opportunities. Um, okay, so taking a look at individual securities to take a look at here. First one I want to take a look at here um, is Crown Castle, the cruise operator. Um, So as you can see, this stock recently broke out here above this 33.5 level here. Oops. Broke out here above this 33.5 level here. It's come back to after the breakout to sort of retest this level as potential support. And that's really where you have the potential for this stock to move higher from here. Crown Castle trades at a pretty significant discount to its industry. It's only trading at around 13 times forward earnings versus the industry median is around 17. So you're looking at a healthy, 20-25% discount to its peers. Yet if you look at growth expectations, it's largely coming in line with its group. If you look at profitability, comes in line with its group. It's just trading at a 25% discount, and that's where it can play a little bit of catch up here. And now that you've gotten that breakout here above that 33 and 32 and a half triple top, that's really the potential signal that the timing is right for this stock to potentially play a little bit of catch up here. They just reinstated their dividend, signaling confidence in the business in terms of being able to return cash to shareholders. And, their guidance has recently outperformed what analysts were expecting. So that's part of why the stock has jumped higher here. And that's why heading into earnings next month, I like Carnival Cruise. Next one I want to take a look at here is Aton. Um, they are the power generators or they build power generators, power unit supplies for data centers. And as data centers are in high demand at the moment. If you look at this kind of breakout here above 350, you have this kind of base that recently formed. We've got that breakout here. We're looking for that continuation higher here. A ton trades at a slight premium to its peers at around 27 times forward earnings versus 25 for the group. But if you look at growth expectations, you look at profitability, it far exceeds its industry. So the fact that it trades at a small premium, I think, is more than justified, especially when you look at growth expectations. We're looking at 13, 14% EPS growth, 10% revenue growth, and their orders have accelerated 200% last year as a result of the tremendous demand that they see from data centers, and they have backlogs all the way through 2027. So, incredible amount of visibility into their revenue growth. And the fact that they're still trading at a valuation that's essentially in line with the industry represents the upside potential here for Aton. Um, the next one I want to take a look at here is a group that has not been particularly well loved, but I still think is worth paying attention to here is the health insurance companies. If you look at Cigna, Cigna showing a little bit of strength here over the last few months. As you can see, it started to trade back up into that 270, 280 level and just recently broke out here above that level and filled the gap. Now that the gap is filled, I think we have the potential for this to continue moving higher here. Cigna trades at 9 times forward earnings. So, about a 25, 30% discount to its peers, even though it's expected to grow faster than its peers and it's more profitable than its peers. So, the guidance that the management team has provided is that they expect to return a fair amount of cash to shareholders this year in the form of buybacks in 2026. That is a fairly strong vote of confidence from the management team when they do that. Especially it reflects the management team's view that the valuation is undervalued. That's why they would buy their own stock. And then, we're seeing relatively good results out of their specialty and care services where revenues grew 14% year over year. So the fact that it only trades at 9 times forward earnings, I think looks fairly constructive here for Cigna to start showing some upside potential here. At the same time, a couple of other names that I think are worth paying attention to here, Carrier Group. These guys do the HVAC units, which is in high demand for data centers. This stock struggled, towards the second half of last year, formed this big bottoming formation, recently just broke out above 60, well on its way potentially to fill this gap here, which is just shy of 80 in that 79 range. That's our upside target here. It did generate a bearish counter trend trade, which just simply means that it's had a very strong move here in the short run. So this is the one where you'd want to wait a little bit. This is one where you want to try to be a little bit more patient. See if you do get a little bit of a pullback here in the next couple of days. And that pullback gives you a better entry for a slingshot move higher here. Another one is Charter Communications. This trades at a pretty significant discount. They've recently, have been performing incredibly poorly, but, start to show some signs that that downtrend is breaking out to the upside. As you can see, that trend quality is improved and has stayed improved here for the better part of a week. And now we're looking for potentially some further upside here from Charter Communications. Um, Another one I think worth paying attention to here is CME. The Chicago Mercantile Exchange. This is where predominantly futures are traded, VIX futures, Treasury futures. This is really where we're seeing a lot of that volatility here in the markets here. And as markets remain volatile, exchanges generally benefit from that type of volatility. I expect that volatility to remain somewhat elevated here over the next few months. And CME is a net beneficiary of that kind of volatility. And I'll leave you with one more name that I think is worth paying attention to these days, which is not a household name, but and probably something you haven't thought of in a while, Motorola Solutions. Motorola Solutions obviously no longer builds smartphones, or rather flip phones like they used to back in the day. They now build enterprise level devices in the form of, walkie-talkies, body cams, those types of enterprise wearable devices for communication devices, recording devices for law enforcement, military, those types of purposes, and has been doing quite well in that particular space and starting to see some, decent growth here from the stock, as well as starting to show signs of recovery from a profitability perspective and trades at a discount relative to its peers. And if you look at that trend quality, it just started to turn both 1 month and 6 month trends are bullish after, what has been a long road to recovery. But similarly to Carrier Group, it recently generated a counter trend bearish signal. And again, that just means that the stock has run a lot in the last 2 months or so. And typically, when you have such strong runs, it's due for a little bit of a pullback here or a little bit of a consolidation. And when you do have that, that is your opportunity to look for further upside, but worth having on your watch list at the moment in options play. So with that, that covers what I wanted to share with you here today. Hopefully that gives you a better understanding of where we currently sit from a macroeconomic perspective, what's our views there, and some individual ideas as far as what's moving in the broader markets these days. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.